Good afternoon and welcome to this James Cooper Creston webinar on Financial Reporting Standard 102, the story so far. We'll spend around 30 minutes on this webinar. If people have some questions for us as they go through, then please do ask them, and we'll pick them up either as we go or at the end, depending on how things are going. My name's Alan Poole. I'm one of the Audit and Assurance Partners at James Cooper Creston, and I'm joined by John Bailey. Some of you may have seen or attended some of our previous webinars on FRS 102, which we held before it really started to kick in for most of you. We're now very much in the throes of helping lots of our clients through the transition. Probably around half of our clients who it affects have already either published their accounts or are in the process of doing so under FRS 102. So we've got lots more practical experience now to draw on during this latest webinar. Quick agenda for today's webinar. I'll give a brief background introduction to what it's all about in terms of why FRS 102 is so important. I'll then hand across to John, who will run through some of the key changes, really comparing and contrasting FRS 102 against the pre-existing or old UK GAAP, which many listeners will be very familiar with. I will also touch on some practical experience and just how to go about implementing the changes in practical terms in real life, if you like. And as I said, please do ask questions as they arise, and we'll try and pick those up. And we'll also run a couple of polls during the webinar. Be pleased to have your input to those polls and keep it as interactive as we can. So in terms of the background, a few years ago now, Financial Reporting Standard 100 was issued, and that really sets the scene for all of UK accounting standards going forward. FRS 100 itself doesn't really have any rules in it in terms of accounting. It simply signposts which of the new standards are relevant to different types of entities. The most important ones are FRS 101 and FRS 102. FRS 101 is an interesting standard which is there for subsidiaries of groups where the parent company reports under IFRS. So that might be subsidiaries of listed groups or of overseas groups where the whole group wants to have common accounting policies and accounting practice. So really all the entities in the group can report using IFRS principles. But FRS 101 gives a nice halfway house where all those entities can follow the same accounting principles that are consistent with IFRS, but without having to adopt all of the detailed disclosure requirements that you may be familiar of, which can be quite onerous under IFRS. FRS 102, which will be the focus of today's webinar, is, if you like, the main UK GAAP going forward that applies to pretty much all entities except for very small entities and those entities that will adopt FRS 101 that I've just touched upon. So FRS 102 really is the main standard going forward. Section 1A of FRS 102 is also quite important, and that has the small company requirements. So really similar principles, or indeed the same principles as FRS 102, but with reduced disclosure. FRS 105 is coming soon for very, very small entities. We won't touch on that in any detail today, but just be aware if you are responsible for some very small entities, then FRS 105 is coming, and that sets out the rules, and they're, as you might expect, much more straightforward. There is a new FRS 2015 for really the year that we sit in at the moment. It only really has a 1-year lifespan, in that it's only been issued recently, and it will soon be superseded by Section 1A of FRS 102. But just be aware that for December 2015 year ends and up to and including November 2016 year ends, then the FRS 2015 might apply to you. Everything else though has gone, so all those SAPs and FRSs that we're all familiar with have now gone. And are no longer relevant to companies going forward. And as I've mentioned, we'll focus mainly on FRS 102 today. So what is FRS 102? It's essentially a fundamental rewrite of UK GAAP, so fully new standards replacing all of the old UK GAAP that we know. It is moving us towards IFRS, but it's by no means fully aligned with IFRS. Some of the things that John will go through, some people might think, that's the same as IFRS or it's similar to, but equally you might also notice some differences. As I've mentioned, it impacts most companies, large and small, albeit the smaller companies can use Section 1A, which has reduced disclosures, and as I've mentioned, very small companies will use FRS 105. When does it hit? Well, now really. It's already well in force. It's mandatory for all accounting periods commencing on or after the 1st of January 2015. So assuming a 12-month accounting year, which clearly most companies will have, then it's December 15 year ends and beyond. So many of those December year end companies have already reported under FRS 102, or if not, they'll certainly be reporting in the next couple of months. March year ends are also well underway, and really, even if you've got a September, October, November year end, then it's coming very, very soon for you. You'll see on the screen a transition date. That's 2 years prior to the reporting date, effectively, because under FRS 102 you're required to restate the comparative balance sheet and the comparative profit and loss account in accordance with FRS 102. That effectively means you need to go back 2 years, because you need an opening balance sheet for the previous year for the P&L, which means you've got to go back 2 years, and that's known as the transition date, and that's relevant to a lot of the specifics in terms of when you look at transactions that have occurred after the transition date. So how are companies being affected by FRS 102? There are some significant differences against existing UK GAAP, which John will run through. Some are simple, some are complex, some are wide-ranging in that they impact a large number of entities. Others only impact fairly small number. Thankfully, most of the ones that are wide-reaching are fairly straightforward, and the more complex ones tend to impact only in nichier areas. But there are a couple of exceptions to that, and those will be where John will particularly focus. It could well affect reported profits. This isn't just technical accounting jargon. This can very much hit the bottom line. If it hits the bottom line, it will therefore, or could therefore, impact on tax, could impact bank covenants, and could indeed impact your ability to pay dividends, because you may find that under FRS 102 your profits are lower than they were before, and that would of course impact on things like covenants and dividends. And interestingly, the bank covenants tend to simply say that accounts have been in accordance with UK GAAP. They didn't really predict or take account of changes in UK GAAP. So if you find that your covenants are breached simply because of a change in accounting standards, you might think that's somewhat unfair, but that is something you'll need to talk to your bank about, because they won't just ignore the fact because it's a result of changing accounting standards. There's also significant changes to the look and feel of the accounts aside from numbers. Okay, so just before we hand over to John, I'd like to run the poll where we're asking everyone to let us know, as your accounts move on to FRS 102, are you expecting a change in profits? Do you think your profits might increase? Do you think they might decrease? Do you think they'll stay the same? Or do you simply not know at this stage? So we've just got another few seconds as more people vote. Just give it a little bit longer. Most people's votes are in now, and then we'll rerun this vote at the end to see if your views have changed based on what you've heard today. Okay, so we'll just close that poll now. We've got nobody saying that they expect their profits to increase. Nearly half think it'll decrease. Around a quarter stay the same, and around a quarter don't know. So I'll now hand over to John, who's going to run through some of the key changes compared to existing UK GAAP.
Thanks very much, Alan. As Alan said, I'm going to run through some of the sort of key changes that are impacting on accounts at the moment, and also look at some of the more practical aspects of those. So specifically some of the double entries that are arising when accounting for those differences. So the first thing to look at is the accounting for lease incentives. So this is where you're receiving rent-free periods on a rental operating lease, or you may have some sort of other benefits such as a contribution from the landlord at the outset of that lease. Now previously you would spread this benefit over the period to which the rent was adjusted to the market rate. Now this was often on the first break of the lease, whereas now, regardless of whether that lease is adjusted to market rate, you'll be spreading the benefit over the entire lease term. There is an exception to this rule, and that is if the lease was already in place at the transition date. You can just carry on before as if FRS 102 didn't apply to that lease. I think the key thing here is just to consider the treatment of new leases that you sign after your transition date and make sure they're accounted for appropriately. So if we just look at a brief example here, if you had entered into a lease after your transition date that lasted for 10 years and you were paying £50,000 per year, and the landlord had given you the first year rent-free with an adjustment to market rate after year 5, under previous UK GAAP, you would be accounting for that £50,000 rent-free period over the first 5 years, resulting in a charge to the profit and loss account of £10,000 per annum for the first 5 years, whereas under FRS 102 it will be a charge of £5,000 over the first 10 years, thus resulting in a £5,000 per year difference for the first 5 years and for the second 5 years of that lease. Second item I'd just like to touch on is the useful life of goodwill. Now previously under old GAAP, goodwill was amortised over its useful economic life. There's no change there, but under old GAAP, if you did not know what that was or didn't assess that, it would be deemed to be 20 years, whereas under the new rules, the assumption is now that that goodwill only has a life of 5 years where you feel you cannot determine its useful economic life. Interestingly though, following some consultations, that has now been changed to 10 years, although those rules will not apply until your second year of applying FRS 102. So this could have quite a significant difference on people's profits and also on people's distributable reserves, where the amortisation of goodwill is potentially accelerated somewhat. Another thing that I will touch on in a minute as well is that under FRS 102, there are potentially more intangible assets that are going to be recognised, mainly during business combinations where we may see things such as customer lists and other related intangibles start to be recognised, although I'll touch on those more in a minute. This is in complete contrast to IFRS, where goodwill is typically not amortised. And again, there are some transitional arrangements that apply here. So there's no retrospective application of this standard prior to your transition date. If previously you were using a life of 20 years, then you would need to redetermine that goodwill life at the transition date, not retrospectively applying that ever since the goodwill had arisen. Now previously you might have a situation where you didn't amortise your goodwill under UK GAAP, and that was permitted where it was determined that it had an indefinite life. That is not permitted under the new UK GAAP, and you need to go back to your transition date and determine what you believe your useful economic life to be when starting to amortise that. So that is quite a key consideration when you previously haven't amortised goodwill. Next, we just talk briefly about business combinations. This is quite a big change for entities that are preparing group accounts and subsequently make an acquisition. Previously under goodwill, old UK GAAP, your calculation for goodwill would simply be the consideration you had paid for that entity less the value of or the fair value of the net assets you had acquired, and the balance resulting from that would just be treated as goodwill. Whereas now under FRS 102, the key thing is to look at what you're actually buying. So have you acquired some customer list? Have you acquired a brand, a website, potentially things like supplier relationships, and put a value onto those? Now, this is probably where the sort of practical side becomes very difficult. How do you go about valuing those separate intangibles that you've acquired? Most of our clients have found that actually they don't have the sort of capabilities or the know-how internally to do that, and have outsourced it to other valuation specialists. I personally haven't done very much of this valuation work, and I think where we're acting as auditors for companies, then we would certainly be looking for somebody to do a professional valuation on that. So if you have made acquisitions since your transition date, definitely something to be thinking about and talking to us about, so that we can get the ball rolling on that sort of thing as soon as possible. One of the second changes is that under old GAAP, you had a strange situation where if you disposed of a subsidiary, or not disposed of a subsidiary, but were deemed to have disposed of a subsidiary, so for example by diluting your shareholding by the subsidiary issuing new shares, you ended up with a deemed disposal, which could result in a profit flowing up through your profit and loss accounts in your group accounts. Now this was always slightly strange because it wasn't really a realised profit, and nothing had changed in your control of that entity. That ability to do that has now been removed, and any gain or loss and movement in minority interest is now being reflected directly in the reserves. So if you have a profit that was previously recognised, say in your prior year, from a deemed disposal, then you could potentially see that profit removed and a significant reduction in the profit that you're presenting in your financial statements. If that's of concern, then please do talk to us. And old GAAP, merger accounting was permitted in certain circumstances. Under FRS 102, it is generally not permitted, certainly not for affecting business combinations. It is permitted during certain group reorganisations where a business combination hasn't really taken place. There are some quite key transitional arrangements in the business combination section of FRS 102, in that if you have made acquisitions prior to your transition date, you do not need to go back and retrospectively apply this standard, i.e. you don't need to go out and separate out the intangible assets from the goodwill. It may be that there's a very good reason for applying this standard retrospectively, however, though, and you could go back and retrospectively apply it to a previous acquisition. If you apply it to a previous acquisition, you must then apply it to every single acquisition that you have entered into after that date. I think in reality it will be rare that people will go back and do that, simply because of the availability of information to come to a sensible decision on the value of any intangibles. I think what's important to say here as well is that a business combination in FRS 102 is not just defined as the acquisition of shares or of a company. It's also defined as the acquisition of any sort of business. So it could be that you made an asset purchase and previously you would have just had a goodwill balance, whereas you may find now that you're going to start allocating out separate intangible assets. But I think this is one of the key areas where if you've got concerns, that we need to be involved at an early stage. The next point to just touch on it is a holiday pay accrual. Under the old UK GAAP, there was no specific requirement to account for the holiday pay and the benefit that had accrued to staff. Although in reality, some people did start accounting for this earlier, and not just because of FRS 102, just because they felt that the figure was material enough to their accounts to account for it. So on a very basic level, the important thing is that you need to accrue for the holiday benefits that employees are entitled to but have not used at the year end. We'll come on to a brief example in a minute of how that might be calculated in one instance. I mean, this could potentially be an issue to your company accounts if either you have a significant number of staff and therefore a high level of staff costs, and you allow people to carry a lot of holiday over from year to year, or if your holiday year doesn't match your financial year end. And we'll see in the example shortly the potential impact of having a June year end versus a December holiday year end. When you're looking at calculating this balance on the transition to FRS 102, one of the key issues you face could be the records that have been kept in previous years. You're going to need to have pretty accurate holiday records going back to potentially the 1st of January 2014. So hopefully those records are all up to date, and certainly the record keeping going forward will need to be accurate. So there's 3 adjustments you're going to need to post here. First of all at the transition date, then at the comparative balance sheet date, and then at your current year-end date. So we're just going to look at a very brief example, a very straightforward example. Let's take a company that has 5 employees, a holiday year-end of December, and a company year-end of June. Employees can't carry holiday over,
and they get 24 days holiday per year.
Let's take one of these employees who at the end of the year-end has used 4 days holiday and had a salary of £24,000 per annum. You would calculate the accrual by working out what entitlement to holiday the employee had earned. So in this instance, they're entitled to half of their 24 days because it is June, and that means at that point they are entitled to 12 days holiday. They've actually taken 4, so they effectively owed 8 days. And then what you simply do is work out what their daily rate of pay is and multiply that by the amount of days that they are effectively owed, which becomes £24,000 divided by 260 days, which is considered in most instances to be the number of working days in the year, and then multiply that by the number of days, which comes to £738 in that instance. Obviously you may have more than one employee that has used their holiday entitlement, and you need to repeat that for each employee. There's been some other changes to investment properties, a slightly wider definition, and you can now now capture where parent companies or subsidiary companies have leased property to other members of the group. Previously under old UK GAAP that would not have been deemed to be an investment property, whereas now it will be deemed to be an investment property in the company that is leasing it to the other. Changes in fair value would previously have been measured directly through the reserves and through the statement of total recognised gains and losses, or struggle for short, whereas now we're going to see them measured directly in profit and loss, potentially creating some quite large variances in profits and losses, especially over the last couple of years where certainly residential property prices have increased significantly. There does seem to have been a slight alignment in treatment with IFRS in this area in particular, although I don't propose to talk too much about the differences between IFRS and old UK GAAP. There is an option on revaluing these properties if the directors deem that revaluation would involve undue cost or effort. Now, I think in reality, if you're running a property investment business and that's what you do, it would be difficult to argue that there would be undue cost or effort involved in that. If, for example, you did have one group company that was leasing a property to another and it was deemed to be an investment property and you didn't feel there was a material difference between the book value and the revalued amount, then potentially you could use that argument. Although I think in reality we're seeing most clients revalue all of their investment properties. Recognition of deferred tax. Previously under old UK GAAP you didn't have to account for any deferred tax unless there was a binding commitment to sale at the balance sheet date. From now on though, we're going to be calculating deferred tax at every balance sheet date. Again, this could give rise to some quite big changes in profits, especially if rental properties have been held for a long time and large gains would be realised on their sale. So again, this could potentially impact on not only profits but distributable profits. I think it's important to say that deferred tax here is just a paper entry. There's no actual tax that will arise in this instance if the property is not sold at the year end. Which leads us on to financial instruments, which are probably the area of FRS 102 which have seen the largest change and certainly brought in line with IFRS here. So we have two types of financial instruments, basic or non-basic. The basic financial instruments, things like trade debtors, trade creditors, cash, things that are just arise every day and are settled in the sort of normal terms of business, say within 30 days or 60 days, depending on your terms. These are just going to be measured at amortised cost, which is no different from the old UK GAAP. Non-basic financial instruments, for example, derivatives, foreign exchange forward contracts, these are going to be measured at fair value. Now, this could bring items onto the balance sheet that were previously not there, specifically things like derivatives, which will now be accounted for at fair value. We're going to look at a couple of what are hopefully reasonably straightforward examples in a minute. One of the key things here with the financial instrument is that you're going to need the fair value at the transition date and at each subsequent year end. Now, we've had a number of clients ask us how they're going to attain this, and I think if you're using things like forward exchange contracts and things like that, you should be able to get a valuation of those contracts from either the bank or if you're using things like derivatives, so you're trading financial instruments, then potentially you would get that from your broker, or again you could be looking to get a professional valuation. I think if you've got things that you think are complex financial instruments, again the advice is talk to us and we'll be able to advise you the best way about obtaining valuations for these things. So a brief example on one specific financial instrument, which is FX contracts. I think this is probably the financial instrument or derivative that we've seen most of our clients have, especially where they're trading overseas and they're looking to mitigate their forward exchange risk. Previously under old GAAP, unless you were chosen to apply certain accounting standards, you would just disclose the commitment, saying maybe that you were committed to purchase $1 million worth of sterling, and you would just disclose that in the financial statements. Now, as I've said before, you're accounting for these at fair value through the profit and loss account. In the FX contract instance, the fair value is the difference between the forward exchange contract rate and the rate for which you could purchase a similar contract at the year end. So if, for example, you committed to purchase $1 million at a rate of $1.5 to the pound, your contract cost at the initial recognition is £667,000. At the year end, you could purchase the same equivalent contract, but the rate you would get would be $1.6 to the pound. Let's assume that the whole of that contract is still open at the year end, and therefore you come down to the fair value of the FX forward being worth £42,000. That's your initial recognition of the 667,000 less the 625,000 that you could purchase that contract for at the year end, assuming the rate was 1.6. You've made a gain in this instance, and the double entry simply becomes debit assets. Typically we're seeing clients post this to a financial instruments or financial instrument asset line, and a credit to the P&L of 42,000, which we're seeing go through a fair value movement line on the P&L. The second financial instruments that I want to just touch on are the non-market rate loans. Now, typically these are loans that have been made to or from related parties where either they're not charging interest or interest is being charged at a very low rate, which is not then a market rate. You then need to adjust these loans to take account of the fact that they're not at a market interest rate and start charging interest using what's called the effective interest rate method. Where loans are repayable on demand or within 1 year, there's no change from old GAAP, and these will simply be accounted for at the original transaction cost. If we take a very brief example here, a subsidiary borrowed £1 million from its parent, the amount was unsecured, didn't bear interest and was repayable in 3 years, and if they were to go to a bank, for example, and borrow that, they would be looking to pay 10% interest. You would therefore need to discount using a discount factor of 10% those amounts can be calculated quite easily using Excel. Now, the accounting treatment of the discount that you effectively receive on the initial recognition of the loan depends on who's made that loan. So if we just pick up that table there, if the loan had been made from the parent company to a subsidiary company, it's treated as a capital contribution in the subsidiary, an increase in investment in the parent. So the double entry in the subsidiary would be to debit the loan and credit a capital contribution in the reserve section of the balance sheet. And in the parent company, it would be to debit investment and credit loan in the balance sheet. So just the balance sheet movement there. If the loan was made from the subsidiary to the parent, you would effectively treat it as if a distribution had been made to the parent company and as if the parent company had received a capital contribution from the subsidiary. If the loan is going from subsidiary to subsidiary, it becomes slightly more complex because it all depends on who is instructing that loan to be made. If they're deciding to loan that off their own back, then the company making the loan would account for that as an interest cost, which would then unwind over the life of the loan, and the person receiving the loan would account for that as interest received at the initial point of recognition and account for that as interest cost over the life of the loan. If the loan's made from a shareholder to the company, it's pretty much treated as the same way as if the parent company had made it, i.e. credit capital contribution, debit loan. And they're the sort of main things that we wanted to touch on today. And I'm going to hand back over to Alan now, who's just going to wrap things up.
Yeah, just a few more minutes from me to wrap up. Briefly on the format and language of the financial statements under FRS 102. Just be aware that the accounts will look and feel very different, even if you might think there's going to be no changes to the numbers. There'll be, the accounts will be into an IFRS-like style. So the cash flow statement, for example, looks very different. And we now have a statement of changes in equity, which replaces the shareholders' funds reconciliation. So there are some real changes in the format. In terms of terminology, the standards are all written in IFRS language. So things like debtors are called receivables and stock is called inventory, etc. But you're not obliged to use that new terminology. You can stick with the old UK GAAP terminology if you prefer. I suspect over time the newer terminology will become prevalent. Because the first bullet on that sheet, the standard requires you to give disclosure of the impact of the change in GAAP, and best practice is to include full reconciliation. So starting with the profit and the balance sheet as reported under old GAAP, reconciling the changes on adoption of FRS 102 to then get to the restated comparative profit and balance sheet. You also need to reconsider the disclosure of your accounting policies because some of those may simply not be appropriate under the new GAAP and therefore need to be rewritten. Okay. So just to summarise some of the effects that you might see on profits here, going through really the things that John talked about, but just to specifically pick out what they might do to your profit. So we've seen that goodwill is likely to be amortised more quickly. We've also seen that we're likely to pick out more intangible assets as separate from goodwill in acquisitions, and typically those intangible assets will have a shorter useful economic life than the goodwill. So that's two things pointing in the same direction in terms of reducing profits. We'll also be bringing in holiday pay accruals in many cases. We'll also be writing off lease incentives over a longer period, so that will, or typically we will anyway, so that will typically have a short-term reduction in profit, but no long-term effect because that will come back. Investment property revaluations, I think what that really does is introduces more volatility into profits because things that typically, well, not typically, things that would never have appeared in the P&L before are now going to appear in the P&L. Obviously they can go in either direction, but again more volatility. Likewise with derivatives, we're now bringing in things like FX contracts to create a profit or a loss in the P&L. So again, that will be more volatility. I think the first four bullets on that screen will almost always reduce profits, or typically will reduce profits. The investment properties and derivatives could obviously go either way. Very briefly on tax implications, John mentioned deferred tax on property revaluations for the first time, and also there's going to be knock-on tax implications from some but not all of the above bullets. So something like a holiday pay accrual would be tax deductible, so that would impact on the tax. We could do a whole webinar on the tax implications, and indeed we probably will in due course, so I'm not going to spend any more time on that now. I'd just like to really quickly rerun the poll. So based on what you've hopefully learned over the last 30 minutes or so, so now with that slightly additional knowledge, what do we now think will happen to our profits as we move on to FRS 102? Will they increase? Will they decrease? Will they stay the same? Or do we not know? And we'll just give a few more seconds for some more votes. Most votes are in now. And we'll just close that down now. Thank you. Okay, so the first time we ran the poll, we had nobody saying their profits would increase. We've now got 9%, so a small minority, but now some do believe their profits will increase. Many more people now think their profits will decrease than did before. That's gone from just under half to 60%. Around a quarter said they thought they would stay the same, and that has stayed the same, so still a quarter we think will stay the same. And obviously John talked some sense, because we've gone from a third of you not knowing to almost nobody now not knowing, so that's good news for us at least. Okay, so we're basically there now. Just be aware there are some key changes. I just noticed one question's come through, so I'll pick that up in a moment. So we've got some key changes against existing UK GAAP. It is likely to reduce profits in many cases. 60% of those on the live webinar think it's going to. That being the case, let's talk to those stakeholders, particularly the bank. Is it going to impact covenants? If so, let's renegotiate those covenants now before it's too late. And talk to shareholders as well, because we don't want to surprise our shareholders with a reduced profit. Have a transition plan, so how are we going to go about adopting this, who's going to do it and when. In terms of the when, make sure you know your transition date and plan accordingly. Think about whether you want to buy some software or get some advice from outside parties, whether us or somebody else, or if you feel you can handle it internally, then obviously that's fantastic. Also, we would never suggest that you run your business around accounting rules, in terms of the tail wagging the dog. But one simple thing that we've done in our own business, for example, is we've changed our holiday year end to now coincide with our accounting year end. So that's one simple change that could be made to a business that probably isn't going to impact the business in any detrimental way, but will make the accounting a little bit easier. So there are some things like that you could do. Okay, so we've got one question that's come in terms that's going back to the financial instruments bit that John covered. The question is, would interest-free loans from directors have to be discounted? I would say yes. Assuming that the business couldn't have gone out to get that loan interest-free, then there is clearly some sort of discount in there. I suppose typically directors' loans don't have a fixed term, and if something is repayable on demand or within a year, say, then you wouldn't discount, because the discount would just be immaterial because it's being discounted over such a short period. But if that loan was a formal loan with a fixed repayment date long into the future, then I would say yes, it would need to be discounted. Okay. If anyone's got any more questions, I think it's now or never. We're just about to wrap up. Thank you very much for joining us. Thanks for your attention. Thanks to John for taking us through the more difficult parts of today's webinar. If you have any further questions, then our contact details are on the screen. Please do get in touch and we'll help you as much as we can. Thanks very much.